Good evening, everyone. Thank you very much for coming and taking off time. Uh, so the central question that the presentation today will cover is how much can asset portfolios of rural households benefit from formal financial services? This is a question that's of central importance to everyone in this room. And I think that at least the first part of the question, can asset portfolios of rural households gain at all from financial services? The answer to that is something that all of us here sort of intuitively understand. And it informs and drives the work that we do at IFMR. But what we're going to do in this presentation is to move beyond an intuitive explanation and to see if we can come up with an explanation that's based in the tenets of modern financial theory. So to lay out the context, everybody here understands that there's a demonstrated demand for formal financial services from rural households. But despite this demonstrated demand, the penetration of these formal instruments in their asset portfolios remains very, very low. To give you one statistic, the latest edition of the Financial Stability Report of the RBI tells us that financial savings as a percentage of GDP over the years 2005 to 2012 has fallen from 12% to 7%. And in the same time period, investments in physical assets and valuables like gold has increased by about 3 to 5%. Now, this seems a little bit at odds with what financial theory is telling us. Really, access to capital markets and financial markets ought to offer households with a larger set of asset choices, a more diversified portfolio, a more liquid and tradable portfolio. So there seems to be some paradox. This sort of drives why we want to answer this question. And in the context of this, there are two questions that are really important. And we've outlined the presentation in order to answer these two questions. The first question is, what does the asset portfolio of rural households in India today look like? What do we know about them? And for this, we'll be using data, customer data from a rural financial institution that operates in 3 states in India. The second part of this question is if the existing financial portfolios of these households could be hypothetically replaced with a set of financial instruments, what sort of gains, if any, would you see? Now, in order to answer this question, we need to lay out a certain contextual and conceptual framework in order to answer this question. And by conceptual framework, we really mean we need to understand modern portfolio theory in a little bit more detail. The foundations of modern portfolio theory really was laid by Markowitz and its seminal paper, 1952 paper, Portfolio Selection. Now, this was the first sort of mathematical articulation of the fact that an investor could lower his risk by holding some combination of 2 risky assets instead of holding one risky asset individually. Now, this seems like a mathematical explanation of the old adage, don't put all your eggs into one basket. And it seems really obvious to us now. This is because Markowitz's contribution sort of set the tone for much of modern portfolio theory. And other seminal contributions, including the Kaplan model that's used extensively today, builds on Markowitz's model. Now, the book Feli, co-edited by Bindu and Amit Shah, has a great chapter on efficient frontiers and portfolio allocation. And we'll begin with sort of a worked out example that derives greatly from that particular chapter. Just to give you a sense from Markowitz's paper itself, he says that not only does the expected returns and variance of returns hypothesis imply diversification, it implies the right kind of diversification for the right reason. If you look at the third line, he says that a portfolio with 60 different railway securities, for instance, would not be as well diversified as the same portfolio with some railroads, some public utility, and various sorts of manufacturing, etc. So it's not the number of assets that you hold, it's really how correlated these individual assets are that will determine how well your portfolio performs. Just to take a worked out example of this, imagine a case where there are 2 assets. One is a risk-free asset, which gives you a return of 8% with no risk attached with it. and another is a risky asset, which gives you a return of 20% at a standard deviation of about 28%. What the table to your right does is to calculate the portfolio return and the portfolio standard deviation on this. The portfolio return is nothing but a weighted average of the individual returns, while the portfolio standard deviation is a function of both individual standard deviations and the covariance between the two risky assets. So in this case, since one asset is a risk-free asset, there is no correlation at all. Now, the graph to your left plots what's called the efficient frontier. So on the x-axis is portfolio risk, and on the y-axis is portfolio return. Now, what the efficient frontier tells you is this. Each point on the efficient frontier represents the highest amount of return that you could attain with these two assets for a given level of risk. In other words, this is the most efficient utilization that you can get given an investor's risk appetite. If you move to a case where we remove the risk-free asset and add another risky asset, which gives you a return of 25% and a standard deviation of 33%. And the correlation between asset A and asset B is positive and partial, so the correlation is 37%. We do the same exercise as before to find out the portfolio return and portfolio standard deviation for various different compositions of holding that asset. Now, this is the asset, this is the efficient frontier to the right. Now, if you look at this efficient frontier, you would realize that holding 100% of asset B gives you the maximum return, which is to the top right corner. But it also comes with the concomitant level of risk, which is the highest in the set of portfolios. As you move to the left of this efficient frontier, your risk and return lower until you reach what's called the minimum variance portfolio, which is here. So with this particular composition of assets, this is the lowest level of risk that you can get. Now, the effects of portfolio diversification really hits you as you move further down. Now, no rational investor would invest in anything below this, because at any given risk level, you can get a higher level of return. If you were to add another asset, another risky asset, which is also positively correlated with both asset A and asset B, which we haven't worked out, but is plotted there, you would see even more benefits of diversification. So the egg shape of the efficient frontier, though, is not something that is to be taken for granted. So this is because, so the shape is really driven by what sort of correlation exists between the two assets. Now, if there was no correlation between these two assets, the shape of this curve would mimic what we saw earlier. And if both assets were negatively correlated, there would be even greater benefits from diversification. If you have any questions at this point, we'd be glad to take them, because we hope that everyone's understood this so that we can move into what this is core to the paper's methodology.
So this is for a particular level of risk,
Right. So which the x-axis plots.
which is the same for both the plotted frontiers.
No, yeah. So at a risk level of 20%, you could be here on a frontier with 3 assets and here with a frontier of 2 assets. So this is just the highest level of return. There's a feasible set which is within the bounds of this, but those are inefficient portfolios. So with this, we believe that we can introduce the methodology that we will use to answer the questions that we laid out at the beginning. What we really do is to construct stylized household asset portfolios that we stratify based on primary and secondary sources of income. Then we use the framework that we just saw to assess the performance of that portfolio, replace that portfolio with a hypothetical set of financial assets, assess the return and risk on that, and plot efficient frontiers in order to quantify the financial gains to these households. Now, I'll let Rachit walk you through the first question, which is what do the extent portfolio of rural households look like?
Thanks, Vishnu. Now that Vishnu laid sort of the conceptual framework behind our analysis, I think I'm going to try and answer sort of the first question of, the first question that we pose, which is to say that what does a rural asset portfolio look like today? What does an extent portfolio look like today? And before we really sort of dive deep into the composition of an asset portfolio, I'm just going to sort of give you a little bit of a background about why we take this perspective of looking at households, from their perspective. Why do we think of household finance as its own breed of research? We find from previous research on household finance that households inherently have sort of distinct characteristics, which warrant an analysis or warrant their study sort of independently. And so some of these characteristics include the fact that households face long but finite planning horizons, which we're all familiar with, using the PGTP framework. We've seen what PLAN stands for there. And the fact that household asset portfolios are typically composed of non-tradable and illiquid assets, such as housing. Lots of people invest in buying houses for themselves and their own human capital. And the fact that households often face significant constraints on borrowing, primarily due to the lack of any, liquid assets in their portfolio, which can act as possible collateral. And these are really not new, given that we all sort of work in this space. But yeah, just to sort of lay that bare. Other findings from literature also help us build sort of the motivation behind our entire analysis. Some of these interesting findings I thought I'd highlight to you guys. One of which is, so there are discrepancies between the ideal and the observed financial behavior of households in that, so the way households ought to behave theoretically is not how they actually behave. So for instance, the fact that household finance, or theoretically household finance, is typically analyzed using a life cycle framework, which in other words looks at the asset accumulation pattern of a household, which tends to be hump-shaped. In other words, a household over the course of its working and young years accumulates assets and builds up sort of its reserve of assets, which it draws down upon as it approaches retirement age. But there are other studies based on empirical data that found that not all assets within a household's portfolio necessarily follows that hump-shaped pattern, especially when it comes to financial assets. Financial assets typically tend to increase as a percentage of total assets in a household portfolio as it ages. Financial assets as a percentage of total assets tends to decrease as a percentage of total assets as a household ages, and then increase as it approaches retirement. And one of the possible rationales for this is that younger households tend to invest in sort of illiquid physical assets like houses, which also have sort of a corollary effect of crowding out investment in other financial assets. In that, housing. A lot of households tend to sort of concentrate their wealth on housing. And then I guess the third sort of interesting insight that we find is that household asset portfolios are diverse, they're simple, and they're predominantly invested in low-risk assets. So they are diverse, not in the modern portfolio theory sense, but they're diverse in the sense that depending on the characteristics of the household and the members of the household, depending on the age profiles, the education profiles, where they live, their wealth status, their compositions really vary sort of across the board. And they're simple in that most households tend to invest in very simple assets such as savings bank accounts or fixed deposit type bank accounts, or life insurance products. And lastly, households actively manage their asset portfolios even in the absence of access to formal financial markets. We all know this. I'm sure everybody here has read sort of Portfolios to the Poor. But to say that, for instance, farm households, despite the fact that they're primarily engaged in agriculture, also derive a significant portion of their income from non-farm activities, such as wage labor, and they use this as a risk mitigation strategy more than anything else. And to say that such households not only diversify their sources of income, but also diversify. Sorry, they also diversify there. Yeah, so for a farmer who also diversifies the types of crops he grows, so a farmer will typically not grow the same type of crop all the time, all year round. He or she will try to grow sort of different crops in the same plot of land in case one fails, there's the other. And to say that households also use other productive farm assets such as bullocks as a hedge against uncertainties like rainfall. So, for instance, if rainfall happens to fail in a certain year, a household can make sort of like a distress sale and either liquidate their livestock, a bullock, or possibly rent it out to somebody else to plow their own fields. So this is just to provide you a sense of the fact that households, the financial lives of households and how they interact with financial services is not necessarily very well understood, which is what really motivated us to take a deep dive into what is an asset portfolio of a household look like. So getting into the sort of the nitty-gritty of the data itself, we used a sample set of about 143,000 customers of a rural financial institution, which is spread across 5 remote rural districts in Tamil Nadu, in Uttarakhand, and in Orissa, across 201 branches. Okay, so with that, so this is kind of like a snapshot of what we mean by a stylized asset portfolio. This is how we sort of constructed an asset portfolio of a typical or an archetypical household. And you'll see we've sort of bunched together assets into asset categories ranging from electronics to shop. You'll also, and you can see sort of the relative proportion in their entire asset portfolio. And the reason I call it a stylized asset portfolio, and the reason I say that we constructed this, is because the median value which corresponds to each of these categories is really the median value within each asset category, which in other words is saying that 7,000 rupees for electronics is really the 50th percentile value of all the values of all the electronics owned in that entire data set. So what I'm also saying is that this doesn't represent a real household. This is a hypothetical household that we constructed in order to most adequately sort of represent the typical household in the rural setting in which the RFI operates. Is that clear to everyone? Okay.
So did you adjust for example, house, and that almost 100 rupees, did you sort of adjust for the land rates or something?
No. Right now we've taken sort of like an all India number.
Who bought house?
Yeah, who own house.
Or rental?
No, these are only people who own house. Yeah, so this is just asset ownership. Everything is owned here.
Just to add to that, the way I think data is captured also reverses the plot on which the house is located from the building itself. So the value of the house is captured as a particular wall and roof type combination.
Yeah. So the other thing to sort of point out here is how we've classified our asset categories into consumption assets and investment assets. And the way we've defined sort of these two classifications is that investment assets are all assets that serve a productive purpose for households, and these are assets that households typically use as a source of income. Investment assets are also those types of assets that households typically use to actively manage their portfolio, to sort of buy and sell, and in order to smooth their consumption over time, as opposed to consumption assets, which, as the name suggests, is really used. These are assets that are used for the sake of consumption and whose value is really sort of drawn down over time. The other point I quickly want to make is that the reason we include house as a consumption asset is because it was not clear to us, given the lack of rental markets and given the lack of property markets in the area in which this RFI operates, that households can really use houses as a tool to sort of actively manage their asset portfolios. And so we saw no rationale in sort of putting it into our investment assets. And then we tried to sort of classify all of the types of all the households in our sample by their occupation, by their primary and secondary occupation. So primary occupation really means sort of the highest source of income that a household might have. So for instance, if there are multiple members in a household engaged in the same occupation, then their primary occupation would be, say, labor or agriculture. And despite the fact that there might be more than one person engaged in the same occupation, that household will not have a secondary occupation. So it's really just this, the most predominant source of income. And what's interesting here is that 51%, more than half of our sample, are engaged primarily in labor. And so across sort of the 8 categories in which we classify households based on their occupation, which are labor, agri and allied, activities, business, salaried, working abroad, professional, migrant, non-earned and unpaid and unemployed. And so the non-earned category really represents those households that earn any form of income without the use of their human capital. So this could include pensioners, or this could include people who derive all of their income from rental income. So no use of their human capital. So if you look at the secondary occupation chart here, you'll see that 56%, again more than half of the sample, really has no secondary source of income. And in terms of their income streams, like we talked about, they are sort of completely undiversified and most vulnerable in that sense, because they've concentrated all of their source of income into one source. All of their income basically comes from one source. Okay.
We actually discussed that this is very uncharacteristic of what we understand of rural households.
Right. Yeah.
Anecdotally, we keep hearing that rural households have multiple sources.
Correct. But most don't seem to have a secondary source. When we did look at things from a regional perspective, we did find some interesting insights. So for instance, here, even when we tried to construct sort of stylized asset portfolios, we found that in Orissa, the median value of house was far higher than the median value in Tamil Nadu and in Uttarakhand. And initially we were slightly surprised, and we were like, well, what might be happening here? Right? I guess we anecdotally believe that Orissa tends to be the most low-income segment, or customers. But I think when we sort of looked around and dug around a little more, we found that a lot of the houses that were built in the area in which this RFI operates in Orissa were actually built by a Congress, a UPA-led scheme, which was what was it called? The Awas Yojana, Indira Awas Yojana. Yeah.
So this area that's prone to cyclones.
Yeah.
So then the wall and roof-type combination said RCC concrete, which automatically led to the per unit value being higher.
So based on those based on the most prominent primary, secondary occupation types, we try to focus our analysis on these 5 primary, secondary household typologies that we created, which include agriculture only. So this is the type of household that has agriculture as their primary and only source of income. Then you have your labor only, similarly. You have salaried agri, you have business agri, and labor agri. And so the way to read this chart would be, so the bottommost part of all of these bars represent consumption assets, which for the sake of our analysis is not important. We focus on investment assets, so everything above the little dotted portion, which primarily includes jewelry, land, and livestock, all physical assets in a household's portfolio. So what's also interesting here is that if you look at the labor-only category, we saw that this is the predominant, the most frequent category in our sample. And we found that the value of all of their consumption assets, you can actually kind of see it here, the value of their consumption assets actually exceeds the value of their investment assets. And I think that's true only, that's that. And the fact that they're very heavily invested in jewelry. Everybody else is pretty highly invested in land, like you can see, and jewelry.
Is there any land in the neighborhood?
Which one? In the labor only, yes. There's a tiny sliver of land. Okay, so with that, So now that we saw that the three most prominent investment assets are livestock, land, and jewelry, we tried to estimate the returns and the risk associated with holding these three assets. And the first of which is land. So, I mean, obviously, I think the first way we would have intuitively thought about it is to find real data and try to get a sense of what risk and return might look like. But we also know that it was very hard for us to find any kind of reliable transaction data on land, given the lack of land registries in India, given the fact that even transactions that do actually take place are undervalued because they're trying to meet sort of stamp duty values, and the fact that a lot of households really, if they do happen to sell their land, it's because of like a distress sale that they make. So it's they sell it for far less than their patch of land is actually worth. So that we really couldn't find a robust way to use real empirical data in order to come up with a risk return estimate. And so we decided to model it. We decided to rely on like a theoretical model of risk and return associated with holding land, and really sort of the central assumption or the central principle behind our model is that the value of a patch of land is solely dependent on its yield or on its agricultural output, which assumes two major things. One, that it implies that all the land that we look at, we assume to be agricultural land, which I realize is a conservative estimate to make. It also implies that there are no returns from capital gains. So if the value of a certain patch of land appreciates and you sort of sell it after a certain period of time, that difference in the sale price and the initial purchase price is not taken into account. It's just the value of the yield, from growing crops on a patch of land.
Don't you think price of land will also influence price proximity to a market area or
Correct. So, and that would typically, I would think, show up in capital gains.
So the price of land would depend on the tradability of that land.
Correct.
What is the demand?
Correct.
Is it saleable as a commodity?
Correct. Yeah. So yeah, again, we couldn't find sort of a robust model to take into account all of these factors. We thought this might be the smartest way to go about it, given our time frame. And the way we decided to do it is we assumed. So we found a study that actually collected a lot of empirical data and found that the output per acre of a basket of 44 crops across 17 states in India is about rupees 14,000. So that multiplied by the number of acres of that patch of land would be the value of the land. And we then also found another assumption from, again, these are all empirical studies done. Each of these assumptions is basically derived from an independent study. And that income is about 20 to 35% of the value of the output. And we also modeled in a source of risk, which is the risk associated with rainfall, which we thought is to be the most prominent risk. So more specifically, a 1% deviation from the mean historical rainfall leads to a 1% decline in output. That's the assumption we made there.
it's annual income? 14,000
Um, yeah. We also define what we mean by a drought or a flood event. So if rainfall varies in excess of one standard deviation above or below mean rainfall, then we consider it a drought or a flood event, which implies that the farmer basically receives no income from that year from the sale of his crops. So, and we assume that this patch of land that a household owns is held for a 50-year period. So yeah, to Bama's first point, we did try to model this type of risk associated with variation in rainfall. And the way we did it is, we tried to simulate the variation in rainfall and its effect on output. Like, we said that rainfall affects output using 1,000 different trials, which in other words is a Monte Carlo simulation that we talked about. And so we tried to sort of simulate 1,000 states of the world, saying that if there were 1,000 different outcomes possible in terms of the different variations in rainfall, what would the average output look like? And what would the standard deviation of that average output look like? So that would kind of give you an estimate of the risk and the return associated with holding land for a 50-year period. Is that clear to everyone? Yeah. Okay. The other physical asset that we could not find reliable primary information for was livestock. And yeah, so we also decided to use a theoretical model in order to get a sense with risk and return. Yeah, here we try to project out the cash flows associated with holding a livestock over its expected lifetime value, which is 10 years. And yeah, so we took into account revenue streams, so things like this, the revenue derived from the sale of milk, the sale of manure, and the sale of a calf. The costs included the purchase price of the cow itself, the fodder, medical expenses, which could include regular medical expenses or medical expenses at the onset of disease, and insemination. We assumed the purchase price of rupees 20,000, which we found to be roughly corresponding with an Ongole breed cow. Yeah, and we tried to model in certain sources of risk. The two most prominent were the risk associated with morbidity. So we restricted ourselves to just the incidence of foot and mouth disease, and the risk associated with mortality. So the risk associated with the animal dying during its 10-year lifetime. And we got a sense of mortality and morbidity rates based on primary research conducted by Bangar et al. I think there were a bunch of vets that went around a few states and collected data on what mortality and morbidity rates look like. And just like we did for land, we tried to simulate for the uncertainty associated with morbidity risk, with mortality risk, as well as the possibility of a calf being born. We sort of took all these three uncertainties into account and simulated again for 1,000 different outcomes or 1,000 different states of the world to get a sense of mean return and standard deviation in that mean return. So after all of our modeling, we arrived at these values of returns and standard deviation, which is used to represent risk. So you'll notice that, so gold, I didn't talk about gold because we used a national level index, the MCX index, and we found pretty robust data to sort of get a sense of returns, which is at about 14.6% and the risk level being 18.7. I guess what's interesting here is that gold seems to have the highest amount of return, but with also the highest amount of risk associated with it. You'll notice that the returns associated with holding land and the risk associated with it seem low, and they might be artificially low because I talked about all the slightly conservative estimates that we had to make. So yeah, taking into account these risk and return profiles, or these risk and return levels of these physical assets, we tried to look at what the risk and return profile would look like for existing households today, or households with their existing asset portfolios today. So the 5 typologies that I earlier spoke about: agri only, labor only, salaried agri, business agri, and labor agri. I guess the only interesting thing to me here is that your labor only category seems to be availing of the highest annual return, but also facing the highest amount of risk. And this is fairly obvious given that it's very high concentration in gold, like we saw earlier. Yeah, so with that, I think I'm going to leave Vishnu to sort of answer the next part of our question, or actually the most crucial, the second part of our analysis.
Then the first question was, what does the existing portfolio look like, which is what Rachit walked you through. The second question is the whole question of what are the benefits of formal financial services entering into the asset portfolio of this household. So we do this across 3 steps. So A, we introduce 2 insurance products, which is rainfall insurance and livestock insurance, and see what the efficiency gains are from that. Second, we replace the existing portfolio of physical assets with a suite of 6 financial assets. And then on top of that, in the third stage, we add a pensions product. So how we modeled, so insurance has been modeled in, so we just, like Rachit said, we remodeled the 10,000 states of the world, keeping in mind that this household now has insurance. So if the livestock dies, you get the value, initial value of the household, of the livestock from the insurance company. And if there's a drought or a flood event, then what happens is that the shortfall from your value of the output is covered by the insurance company. And we attach premiums as costs with it. Now, if you look at it, the annual returns, look at the change in returns For land, the change in risk and return is very, very low. This is primarily because we have taken it over a 50-year period. For livestock, though, the change in risk is significant. So the drop in risk is about 8.7%, and returns increase by about 1.8%. Now, with this, we sort of go back to the whole efficient frontier framework that we initially spoke about and plot efficient frontiers for both sets of asset portfolios, with insurance and without insurance. So, the efficient frontier that lies below is the one with only physical assets without the introduction of any financial asset, which in this case is insurance. Now, there are a few things to be noted here. So this graph also plots where the individual stylized portfolios are. So 4 of those, even with respect to their existing asset portfolios, hold inefficient portfolios. Only one stylized household typology, which is the labor-only typology, is right at the frontier. And they have the highest amount of, they take the highest amount of risk and get the highest amount of return. If you remember from what Rachit said, they are primarily over-invested in gold jewelry. If you look at, so the frontier above shows you the comparison with the 2 insurance products that have been introduced. And it's very obvious that this particular efficient frontier completely dominates the extant efficient frontiers. So from this, it's sort of clear that there are efficiency gains to be gained by the introduction of at least 2 insurance products into these portfolios. Now, to us at least, the inefficient portfolios that these stylized households currently have is not very surprising, because physical assets are generally lumpy assets. So at the points at the efficient frontier might tell you that it's most efficient to hold half a cow or 0.2 acres of land, which is not possible. So it's not surprising that they are holding inefficient. But what's significant is that at levels of risk that they currently hold, they could potentially get higher levels of return. And sort of conversely, to attain the existing levels of return that they get, they could potentially get it at lower levels of risk. We also sort of bottle this by replacing the entire asset portfolio of these stylized households with a suite of replacement financial assets. So there are 6 financial assets in this, and this is designed in such a way that it offers the household greater diversification. All the assets here are liquid and tradable assets. So the BSE Top 100 sort of mimics the movement of the stock market. The equity ETF, the exchange traded fund, mimics the returns on the Nifty. There's a savings bank account and G-Secs of varying tenors. Now, we've also made the assumption with each of these stylized households that the level of risk that they currently hold sort of is the revealed level of risk tolerance of each of these households. And so when we replaced their portfolio with financial assets, we sort of optimized it in such a way that their existing level of risk remains. So the first 2 rows really shows you the nominal return and real return on their current portfolios on physical assets. Now, if you see, all households except the labor-only households have a negative real return on their investments. Now, if you were to replace it with these 6 financial assets, you would see that the change in return would vary from about 2.02% to about 3.61% for agri-only households annually. So this is in real terms, this is the change in return that these households should see if they were within the ambit of the formal financial system. Now we go ahead and plot this also on the efficiency frontier, and like before, we see that the efficient frontier of the financial assets dominates the physical asset frontier. We also add a pensions product, namely the National Pension System Swavalamban, which is for the unorganized sector. We also add it to the analysis that we've done earlier. Now, unlike all the other assets in the portfolio, the NPS is probably the only non-tradable asset, and it has very long horizons. If you're 20 and you start putting it, you realize the money only at 60. So for all the others, we did not put a constraint on what's the minimum or the maximum amount of any asset that you could hold in the portfolio. But just with NPS, we said that a household could hold only a maximum of 20% of this asset. And so this example is sort of analogous to the 2 and 3 risky assets. If you add one more asset, you should potentially see greater diversification benefits from it. We really believe that the results of this study is quite significant because it goes, as I said, beyond an intuitive explanation to a sort of quantification of what benefits could be. We believe that the gap between these efficient frontiers, really what it shows us is the welfare loss to these households as a result of them being financially excluded. And one of the things that all of us try to do here is to sort of systematically address the question of financial exclusion. And we believe that there are many policy implications that can be derived from our results. For instance, there's a question of ticket sizes for things like mutual funds, for instance. There's a cap on minimum investments or minimum investment that you should make in mutual funds. So one of the things that we try to do at IFF is to work with regulators in trying to address structural problems like this in order to ensure that that welfare loss is minimized. There are also questions about distribution channels, entry barriers in the form of rigid KYC norms, for instance. All of these are problems that we try to address. We'd like to leave you with one of our favorite quotes on this. It's by Schiller. It says that modern finance is a central pillar of any civilized society, and for society to fully realize its promise, finance has to be expanded, democratized, and humanized by giving people the ability to participate in the financial system as equals. Thank you.